Hey everyone, and welcome to the Love America Hate Taxes podcast. I'm Ryan. This is Don, and today we're going to be talking about real estate and tax strategy. Is it worth the risk and reward?
Yeah,
So it's a pretty interesting conversation. We were just kind of spouting about before we got on this podcast, just about Airbnb and all that stuff. But it sounds, honestly, it sounds kind of sexy. You use your real estate to write off everything. You pay no taxes. You live your best life. But is it really that simple?
yeah. I think that it's great YouTube content and TikTok stuff, get your rentals out there. And listen, there's some people who have been very successful at doing it. But I can tell you, in my 37, almost 38-year career, I've heard a lot of horror stories. But let's talk about the pros before we get
Yeah,
into the
sure.
cons.
Yeah,
How's that
the
sound?
good stuff. We'll
Yeah,
start
yeah.
with the good stuff.
So you hear about, okay, well, you get your home and you get to do a depreciation. And that just means you just, for a residential, it's 27 and a half years, and you get to take whatever you purchased it for. So let's, for illustration's sake, let's say it's $540,000. And just make it for simple terms. That's $20,000 deduction you get to take each year
Mhm.
for 27 and a half years. Okay. So that's the good part of it. And then also there's a thing called cost segregation. So when you buy a house, when you buy a commercial building, now I'm sorry, let me go back. Commercial building is 39 years, so a little bit longer. But ultimately, when you buy whatever kind of building,
Mm.
your house
Mhm,
is an
mhm.
example. How long did you have your house before you had to replace your air conditioner?
About 2 years.
Okay.
Yep,
So that's what happens in any kind of
yep.
rentals or commercial air conditioners, roofs, carpeting, windows, anything, other than the slab and the, the structure itself is going to have to be replaced during that 27 and a half or 39-year
Yeah.
period. So the IRS says, listen, there are certain categories that you can accelerate or bring what they call cost segregation. So an engineer comes out and says, okay, based upon IRS guidelines, your windows are going to last this long, your carpeting this year, your air conditioner, so on and so forth. And you get to accelerate that the depreciation up front. It's
Mhm.
called the cost segregation study. Why is that valuable? Well, for a couple things, and I'll just give you a couple examples that I've worked with here recently. So, number one, a dollar today is always going to be worth more than a dollar in 5 years, 10 years, 27 years from now. Okay, that's number one. Number two, what's the likelihood that you're going to still own that property in 27 and a half or 39 years? Okay,
Mhm.
so that's another thing you got to think of. And number three, you're pulling that forward and you're creating a deduction against passive income. And I'll talk about that here in a second. But it can, when you do rental property, it's considered passive income because you're not actively involved in it. You're getting a renter and you're putting them in there and they're sending you a check every month and you put it on your tax return. Say, so those are the big ones there. Of course, bonus depreciation. People like cash flow. They
Mhm.
think, well, the property's going to appreciate. That's good news. You got cash flow coming in every month. Um, you need to figure out what your net cash flow is on that.
Mm.
That's another issue. Um, you can refinance it
Mhm.
tax free. And then, of course, 1031 exchange. This gentleman I was talking to yesterday has a piece of property over here by the university.
Mhm.
It's appreciated about $250,000.
Wow.
Yeah, so he bought it at a good time.
Yeah.
He's concerned about the neighborhood,
Mhm.
the route the neighborhood's going on. He feels like this would be a good time to sell. So he can do one of two things. He can move back into it. He has to be in the last 5 years. You have to live in it, and you get to be able to take that out tax free. Or what I just mentioned is a 1031 exchange. 1031 exchange just means you find another property out there and you roll all the gains and everything over into that new property.
Okay. Nice. So in theory, you could buy this property, cash flow it, depreciate it, reduce your taxes, refinance, and then pull all the money out while deferring your taxes,
Uh,
essentially.
yeah, pretty much. Yeah.
That's
Yeah.
pretty neat.
So that's all the positives, and that's what
Yeah.
everybody promotes out there because that is a part of it. But yeah, you want to make sure you look at the other things too. So,
Got
matter
it.
of fact, I'll just bring this up. This is a plug. I have a buddy. I'm in a business group together. His name is Greg Lafferty. He's actually a builder here in the Charlotte area.
Okay.
He wrote a book called Rentertainment: Tales of a Landlord. And
Surprised it's not thicker. Yep.
true. I'm sure he could probably read.
That's year one. He didn't do year two and through. Yeah.
But, just reading some of these articles, one of these different chapters in here is very, very interesting. So, one example was he had a duplex, and the lady calls him up and said, "Mr. Gregg, there's a fire at your house, on the other side of the
Mm.
duplex." The people had moved out. So long story short, he goes over there, he puts the fire out, and it's actually a trash can that was on fire
Mhm.
up
Mhm.
next to one of their buildings. He said, "Good news is the building was brick and not wood." He said,
Mhm.
"It would have caught on fire." And he gets in there, and so he leaves, and he gets a phone call the next day from the neighbor saying, "You're not going to believe this," but what it was, and this is the stuff you can't plan for. So the young man who lived there had a girlfriend or ex-girlfriend, let me rephrase that, who got mad because they broke up. So she thought she was just going to set a fire to their house, and this is the type of stuff and he talks about you doing criminal background checks and
Yeah.
just some of the stories he's heard there, or credit background checks and things like that, or collecting rent. I actually had a client, this has been 20 years ago. I was out in New Mexico at the time, and he had four fourplexes. And he said the decision he made to go ahead and get rid of them
Mhm.
was when he went out to collect the rent, and the guy physically assaulted him and put him in the hospital
Wow.
because the guy didn't have the money. So I guess he
Mhm.
decided to beat up his landlord, instead of paying
Oh
rent.
my g well, I know that back during, even after COVID had, made its appearance and left, places in California and other places like that, you could not evict your
Good
tenants,
point. Yeah.
and so they weren't paying 'cause they weren't paying, but yet you couldn't evict them. So there's headaches that come with some of this stuff. So there's tax benefits, but then there's headaches, which kind of rolls us into our next topic. So let's talk about kind of the downside a little bit, some of the risk and traps and things like that people can fall into. So
Yeah, so it's interesting because this new client that we just had a conversation with early this morning. So going through the tax return, I looked down into their Schedule E, and they've got a $150,000 loss,
hmm,
and it keeps on growing each year. It's because they have losses in their real estate for whatever reasons. Maybe they didn't get rent, or maybe they had a big expense or whatever, and but they can't. It just keeps on growing. And the problem is they can't use that against ordinary income. So you might have a $150,000 loss here, but have $300,000 of income that year, and you can't use that against it. It can only be used against passive income, other rental income, or some other type of passive income.
really?
Now, there's a solution to that, and if you're married, you could actually make your wife or your husband, depending upon the scenario, um, a real estate professional. Now, a real estate professional is not necessarily going out and getting a real estate license, even though they could certainly do that. A real estate professional means that 750 hours a year, so 13 hours a month, is going to be dedicated to, pardon, 13 hours a week, sorry, dedicated to managing your property. And so that's the key there. And you have to document it well, because this is something the IRS does put a line on there. If that was the case, and that client of ours, let's say his spouse,
Mhm.
becomes classified as a real estate professional, everything's documented, then we could take that $150,000 deduction there, or
Mhm.
pardon me,
A
loss that they're
lot,
showing,
yeah.
and deduct it against their ordinary income.
Hmm. So that's a great kind of
That's a strategy,
or
buddy.
yeah, that is a strategy. Awesome, awesome.
Yeah.
Any other kind of things to look out for when it comes to that as well?
Yeah, there's a lot of conversation, and we'll talk about some of the things we've been just chatting about here. But short-term rentals, the whole Airbnb, Verbo, all these type of stuff out here, you have to be careful, because how you do it will determine if it's going to be able to be deductible. I hear this a lot with beach houses. Spending too much time in there can change up your ability to do a deduction there. Um, a cost segregation can backfire. We talked about the positives of cost segregation. Let me talk about the backfire.
Mm,
So let's say you have a building that you have a $200,000 cost segregation.
okay.
All right. So that becomes a $200,000 deduction. And you can use that against your passive income, or, like I said, if you're a real estate professional, against your ordinary income. Let's say for whatever reason you sell that property, Ryan, and now you go to sell it. The IRS is very tricky. They don't generally give you a deduction like that there without some kind of strings attached. It's called recapture. So let's say I take that $200,000 and I go ahead, or any depreciation as far as that's concerned, and I go sell that property, and I don't do a 1031 exchange. I don't make it into my primary residence. Then I have to recapture that deduction. So now I got an extra $200,000 back on my tax return
Really?
at 25%.
Oh my
Yeah.
goodness.
So your Uncle Sam doesn't give anything away for free. Just let you know that right now. Over leveraging.
Mhm.
Right now, real estate prices are pretty high. And what happens if we have another 2008? You may not remember that because you're pretty young, but real estate values dropped, and who knows, things can happen. And just compliance, complexity, making sure everything's done properly. So when you turn over to your tax professional, they can legitimately put those deductions down. Now, one last thing I wanted to say. I've seen this unfortunately more than I would like to say, but some CPAs just miss things. And I've looked at a couple tax returns just this year, actually, that when I went into their, so you put this on a Schedule E,
Mhm.
okay? And you line out your rent that you received, your rental income. You put your insurance, your taxes, your mortgage interest, your depreciation, then whatever you have left over, that's your net income.
Mhm.
Well, the depreciation, there was nothing there.
Hmm.
And so I was explaining to this client, I said, we're gonna be able to go back and amend and reflect that.
Mhm.
But the reality is whether you take that or you don't, the IRS, if you go sell that property, is going to do recapture on there because they really don't care if you took the deduction or not. They're going to assume you did, and you're going to have to show that as recapture.
Oh my
So,
goodness.
and pay taxes on it. So fun, fun, fun.
So that goes back to our point on our earlier podcast was that you have a tax planning professional take a look at some of that stuff because you caught that when they would have just continued doing that, you
Yeah.
know? So that's really
So I want to talk a little bit about short-term rentals. I think
yes.
that
Yeah, yeah,
that
yeah.
subject a little bit. So I was just at this meeting on Friday, and there was a lady who was speaking about investments, and she was talking about there's a fund out there for people who want to do short-term rental investing into because the whole idea is having all this income coming in and all this. That's all the glamour.
Mm.
Okay, getting the money. Well, then she went on to explain that she has 17 short-term rentals. One of them was a fourplex, and one of them caught fire, burnt down all four of them to the ground. Her dollars that she said they were just burned up overnight. And now she has no cash flow coming from that. Okay, so a debt service still comes into play. She talked about them being trashed. I was telling you about a neighbor pardon me, a friend of ours who has a Airbnb across the street at his parents' old house. And he told me, he said, the thing I learned is you never, ever, 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 ever do an Airbnb with somebody who's local.
Yeah.
Because why are they not staying at our house? Now there's extenuating circumstances like a flood or something like that. But if they're coming in just for the weekend, they come to your house to party.
Sure.
And he had his whole house trashed because they came over to party. So there's a lot. A matter of fact, you could probably go out there to Reddit or some of these other um, boards and stuff and ask
Yeah.
people who have.
Well, some of your hottest Airbnbs are in places that are for those, like, I think in Nashville being the bachelor and bachelorette capital of the U.S., right? Every Airbnb there is gonna stay with a group of people coming there for one purpose, to have a good time, and I could not imagine having,
Yeah.
what the door cams
Yeah.
would look like,
Well,
but
and there's a
oh my gosh.
yeah, that was putting some stuff on there about people, what they're doing to his short-term rentals. One of them, just recently I saw, where it states specifically the basement is off, no one
Mhm.
can go down in there. Well, one of the people went down there and stole a bunch of stuff. He's got it on camera. And, Airbnb says you can't have cameras inside the house, which I get all that. But this is down in the basement, which is the area they weren't supposed to go. But they caught it on video, them stealing stuff. And
Mm.
matter of fact, I was reading in Greg's book, even his long-term rentals, he goes in there, he said there used to be a bathtub here. People walking off with all kinds of stuff,
Oh my
walking down
goodness.
the street with commodes.
I
Who
don't
knows?
taking this with me. Yeah, I paid for it long enough. Yeah.
Furnished apartment? No problem.
Yeah. Well, I guess, kind of the bottom line is that real estate can be a good tax strategy if it's
Yeah.
done right, not treated like a short-term, thing, but a long-term thing that you can strategize and plan for, things like that, but it does come with its headaches, so be prepared for those type of things, and again, look for a tax planner, that can look at things down the road, current, down the road, future plan, all that good stuff so that you make sure you're in the right, lane, basically.
Yeah, and let me give you a success story. So I have a client up Virginia, and actually we stayed at it. His beach house up in Virginia Beach, beautiful place. And we got what we call the remnant week where they didn't have anybody staying, and we got a really good deal on it. But he rents that out for $19,000 a week in the summertime.
Mhm.
Great cash flow. I know what, because it's right there on the beach. So you got, besides people coming staying, there's wear and tear. But, he has the salt air coming in there and eroding, causing corrosion and
Hang
stuff.
yeah,
Yeah,
yeah.
payment all the time.
Mhm.
So there's certainly some expenses involved, but he still did well. So that was a great success story. And you know, when you're renting it for $19,000 a week, and you're selective on who you allow to come stay at it, you're going to have less risk there. But when you go in there and you have somebody who puts their Airbnb profile, and you might look at some of the warning signs, then there might be an issue,
Yeah.
depending upon their age group and
Yeah.
all those are factors. Having insurance, So, anyways,
All things to consider.
that's it.
Well, guys, thank you so much for joining us for today's podcast. We hope you liked the content. If you did, like and share it. Share it with another business owner, another American taxpayer. We want to hear from you as well. So if you have things that you want to hear us talk about and answers, send us an email. We'll be happy to get those on another podcast. Until we see you again, thanks for watching.
Thank you.